yours?
Yeah.
I'm actually doing burger. Yes, there's one person that this one is open. Yeah, you do it. Yeah, sure. Good, good.
Where do you live, baby? Hot traffic, and you can tell I'm your SOL on the pizza. That's fine. I'm going to be making more than that. A little sugar and a little hydration to keep you going for hours.
It's the winning
So
company.
how's your husband? Let us know. This what year have the contract?
Yes. His company this week is at their plant in
Everyone's excited about those games yesterday. We're all my New Orleans fans. Anyone going to admit that? Bears, who are they? Yeah, you noticed yesterday there were a lot of key field goals that were made at some probably high pressure points. I don't know if Cody could do that. So, any Rams fans? Patriots fans? 1, 2, 3. Just 3 in here. 4? There you go. I'll jump on that bandwagon.
Tag's still on. Tag still on the head.
New Orleans did get robbed. I did not see that game. But when I saw the replay, that was definitely a pass interference. I'm blind without my contacts, and I could have made that call. But welcome to another exciting year. Last year we had a fantastic year, and we'll talk. You saw on the previous slide that we already have 4 or 5 months of speakers lined up. So we're looking forward to another exciting year with great speakers in here. We're going to start off tonight with a fantastic speaker. He spoke at our very first meeting back in 2017. Do you remember how many folks were there? There were 15. So we've grown a little bit since then. But the whole idea of the group is to bring investors together of all different levels. So we have people in here that have done millions and millions of dollars in deals. And we have people in here that it's a pipe dream. They've never done anything. But the whole idea is to provide relevant real estate education as well as a place to grow your network. I know when I got started back in 2015, I joined a group just like this. I didn't know anything about real estate. I didn't know anyone that did anything. All I knew about real estate was what they showed on TVs. And it was a great place for me to grow my network, make some connections. I'm still doing deals with some of the first people I met in that group. A couple of benefits of being part of a group like this is, again, just the network and the value of that network that you build through people that are experienced. Instead of learning the mistakes that experienced people have made, just go pick their brain and learn from them. Education through our monthly speakers, great place to get connected with people of all different trades, lawyers, contractors, accountants, landlords. You can get deals done. Who in here did a deal with someone in the group last year? Loaned them money, bought a house from them, sold a house from them? There's probably a third of you, so there's a great way to connect with people there. Then also, we're going to grow this out a lot more this year, is just vendor connections. Our vendors provide services directly that we can benefit from. In fact, all of the vendors that you saw on the previous slide, I personally use, and they provide a value, which is why we're going to, introduce you to them as well. Real quick disclaimer here: the material and content presented today is for educational purposes only. It's not legal advice, don't take it that way. The content is a recollection of the speaker's personal experiences of their success and or failure. Definitely consult with your own professionals prior to engaging in any activity presented here. The success of the speaker is not a guarantee that you're going to be successful. We're not like those big national gurus that go around teaching you to, you know, hey, if you buy my program, I guarantee you're going to make $1 billion a year. A lot of your success is determined by your effort and your sweat and what you put into it. And they don't like to teach you that stuff because no one wants to learn, you know, realize that you actually have to work to make money. Here's the summary. Just do your own due diligence, speak with your professional circle, and all investments have risk. You may lose money. Who's lost money on a real estate deal? A lot of people in here. It happens. Last month, we did a big donation, and this all went to Intermission, Care Hands, and Hammond. And you can see the picture on the left here. This was last year, and we collected a whopping 160 items last year, which seemed like a lot of items at the time. This previous December, we collected over 700 items, plus a decent amount of gift cards. And this all went to Intermission to go in their soup kitchen to take care of families that aren't as fortunate. So a big thank you for everyone who contributed to that. So in the past month, who did something? This could be a flip, private loan, or if you want to share some of your 2019 real estate goals, that'd be cool too.
I just bought my first SFR.
Cool. Rental or flip?
It's going to be a rental, hoping to cash flow about 200 a month once I refinance.
Cool. How did you find that property?
It was on the MLS actually.
Okay. Cool, thank you. Who else has something they want to share? Someone did something between now and Christmas. You all didn't take vacation, did you? I got backup number 2 here.
Well, over the holidays, I posted 60-some odd bandit signs. We got car magnets for the Levi houses. And I've had 3 approaches and 2 that I'm hoping to get the contract this week.
There you go. Anyone else buy something, flip something, lend money? What did Ellen do? I don't know. You bought me a really nice bottle of bourbon.
I did. I'm buttering you up. You know? No, I lent some money on a single-family home purchase. It's going to be a rehab, converted to a rental, I think. It was supposed to close today. I haven't heard it didn't, so I'm sure we'll get it.
I got paid on it, so.
And it closed.
Who else did something? Awesome. Real quick, if you are not on the Facebook group page, grab your phone. And this is a group that you want to be part of. We announce our upcoming speakers. But more importantly, it's a place where a lot of folks have been able to ask questions. Here are some of the questions that were asked this month. And we probably get 2, 3, or 4 a day, so I can't post everything that we've had going on in the month. We have people that are asking, probably, they run into 3 categories. The 3 categories, it's, you know, hey, I need a contractor in this town that does this. And then we'll have 4 or 5 people, hey, use this person, use that person. We get a lot of landlord questions, hey, can I do this? What would you recommend for this situation? We get questions looking, you know, people, hey, I have this deal, I'm looking for money. I know a lot of people have been able to find money for their deals in there. And then the 4th category, I forget, we always get the Hammond questions. So those are always fun. Those always have like 50 comments. The folks that work at Hammond like to chime in there, and I've actually learned a lot from that. So if you're not on that Facebook group page, go find it. Ask me. Justin will approve it now. Great resource as you're looking to build your investments. All right, real quick, first-time guests. Name where you're from and what you're looking to get out of the meeting. I'll grab this side again.
Hi, my name's Kimberly McLaurin. I'm from Griffith, Indiana. And my husband and I started a company called I Became Properties LLC. And basically what we're trying to do is rehabs, wholesale, passive income. And so we have looked at a property this past week. Hopefully, we'll do something with that coming soon. We'll let you know.
Cool. This is your first time, right?
No, I was at your other building.
Oh, were you? Okay, never mind.
I haven't been here. I've been following.
Hi, my name is Troy. I'm from Valpo, and I just got recently interested in real estate. My dad used to do it a little bit, and so I'm just looking to learn. That's all I'm here for today.
My name is Brandon Rainwater. I'm from Couch, Alabama. Been in love with real estate my whole life when I was in the trades as a painter. And I just started taking my pre-broker course as well.
Cool.
My name is Daniel Updike. From Cherryville, Indiana, just looking for general information on real estate, looking to do flips and rentals eventually.
Jim Pipolo from Chicago. My cousin is Alan, and just here to learn.
My name is Samara, and I just got into real estate. My husband and I started at the end of October. I now have 6 properties under contract for wholesaling. Might have a buyer. I know. It's all good.
I'm Josh Belk. I'm here with the Olsen Group and Good Success. We have a podcast that both Justin and Adrian on. Adrian's going out this Friday, so be on the lookout for that. Just here to get some connections and meeting people for this great group. So,
Thanks for coming.
Hey everybody, I'm Mike Sattler. First time we're meeting here. Been dabbling in real estate for probably 3 or 4 years. Did a couple of flips. Looking to kind of speed things up, network a little bit, and just like everybody else learn. Thanks.
Hello everyone, I'm Brian Woods. I've been in investing years ago, but kind of got away from it. Just getting back to it now and trying to network as far as type of properties. I'm looking for rehabs, rental property, and just looking to basically network with as many people as possible, do some partnerships.
Thanks for coming.
Hi, I'm Ian Napoli. I'm a real estate broker with Prime Real Estate. I've been in real estate investment in real estate for over 15 years. I also own a company that buys and sells distressed debt and secondary. Met Adrian a couple years ago. It's nice to see this big size group, and I'm looking forward to meeting some of you.
I'm Michelle Rollins. I'm a real estate agent, West Listing Leaders. I've been a real estate agent for 7 years. I'm just now currently starting to get into flipping. Hopefully, that's the goal. So I'm in the process of just finding hard money and reliable and serious investors. So that's one of the reasons I'm here, trying to get connections. And also, so that person or company knows I'm serious about it. And just trying to learn more. And eventually, maybe rentals, but flips for now. So glad to be here.
I'm Jashar Hartley. Most people call me Jay. Feel free to use either one. From Chicago, recently relocated to Whiting. Looking to get interested in single-family homes and duplexes, rehabs, and rentals. Looking to build a great network with some progressive professionals and do some deals.
Anyone else want to say hi?
I'm Roseanne Comiskey. Yes, I'm a White Sox fan. This is my first time. I'm from South Holland, Illinois, and I want to learn how to flip.
For the people that are new, how are you hearing about it? Is it Facebook, Craigslist? You just raise a hand or yell it out. How are you guys hearing about the group?
Meetup.com.
Facebook. Okay, a little bit of everything. I just asked because I'm trying to kind of keep track of what's the best marketing avenue for the group. So it seems like every place. Which is fun. My marketing assistant starts in 2 weeks, so I'm super excited about that. You'll see a lot of content coming out for the group that I'm not very good at, which is why I'm hiring someone better. Membership, if you're not interested in membership, you can pay as you come. It's $15 a month. That gets you a seat, gets you pizza if you get here on time, and all that. If you want to become a member, the annual membership is $120 a year for an individual, $160 for a couple. That gets you into all of the meetings for the whole year. That gets you into the website, where we have access to videos going back to the beginning of 2017 when we started this. It also gets you access to a swag bag that has a couple of cool things in it, the Think Realty affiliate program, and a couple of other cool things like that. So typically, Justin, can you grab all the raffle? Typically what we've been doing every month is if you bring a guest, you get a raffle ticket for some swag. This month, because we didn't promote that, we just gave everybody a raffle ticket. So we're going to give away 2 books and a t-shirt. And we're trying to get away from the real estate book thing a little bit, because life isn't just about real estate, even though for a lot of us, that's what it is. We get a bunch tonight. So, John Maxwell, anyone read any of his books? Fantastic author. We have How Successful People Think. And then good old Tony Robbins. I'm sorry I don't have as much energy as him. He's also a little bit taller than me. This is Money, Master the Game, 7 Simple Steps to Financial Freedom. So that's a fantastic read. And then we have one of our shirts. So I will, Hector can help me out here. Just grab it. There's a lot. All right, the first one, I'm going to read the last 4, 6394. 6394, come on up. You can grab the first thing. That one's eliminated. 6281. 6281. They didn't go home already, did they? No? No? You only have 1 ticket to look at this month. 6281. Ready, set, nope. Oh, I grabbed one out. 6280. Oh, look at that. I think you should probably grab a t-shirt. You need to promote our stuff. Or you can take it with me on Maxwell. And let's see here. 6279. 6279. There you go. Are you small? Yeah. We'll go to lunch or something. He already has one. 6288. Is that you? Look at that. We have additional sizes at the office. So next month, if you bring a guest, you'll get a ticket, and we'll give away a couple of things next month as well. All right, since we're not on a government shutdown, we are going to have our State of the Real Estate Union address. So Allison, if you want to come on up. And I didn't get a bio on Allison, so I'm going to have to make it up. Allison's agent with Listing Leader. She's been an agent a very, very long time. She knows her stuff. I'm also a Listing Leader, so I'm in the group. I see what she does. But she's been involved and knows a lot of the ethical and legal sides of listing properties and everything that goes into that stuff. So I asked her to kind of recap 2018, tell us what happened, and then she's going to give her best prediction on where the market is going in 2019. Now keep in mind this is her opinion. You can't hold it to her if it doesn't happen.
Hello.
What number is on that one?
Channel 4. Can you hear me? Okay.
So a little bit, Adrian's kind of on track. I've been in the business since 2013. I am with Listing Leaders, general manager with them. I am also on Ganeyer's board of directors, our government affairs committee. So I am involved in real estate every day, all day. So I also have a company with my husband, renovation homes. So we do also renovating, working to get into rentals now. So a little bit of what we saw last year. It was crazy. We had more buyers, obviously, than we had inventory. So whether you wanted to buy a house to rehab, whether you wanted your single-family home, whether you wanted multi-units, whatever you were looking for, it was usually a competition with 5 other people down the road. Most people, if you're looking at, I have my statistics, and I'll go over those with you. I won't bore you too much with them. But generally what we saw is, you know, just an increase every month going up probably till about August when we started to decline a little bit. But most homes were going over asking price. Amazingly enough, most of them were appraising. We did have some appraisal issues. I am seeing that even at the beginning of this year so far, I'm still loaded with buyers. I'm still having trouble finding some properties to get them into, especially those deals that are on market. So for those of you who are looking to buy investment properties or get into rentals, those units are hard to come by if you're working, you know, on the MLS and searching our inventory. We just don't have it. I know there's a lot of off-market deals that are out there. It's who you know and, you know, having those connections. So talk to each other, you know, because that might be your best bet for getting some of these deals. I know a lot of investors that I've had with me that we were looking through our inventory last year. It was either if we did find it, we were competing with, like I said, 5, 6 other people, or they were gone before we could even get our foot in the door. So I don't think that's necessarily going to be the case this year. I do think we'll have a bit more inventory, but I still think it's going to be somewhat slim pickings for everyone. Prices probably aren't going to skyrocket like they did last year. I think you could ask a lot more last year than you're going to be able to ask for this year. Our interest rates this year, we should have 3 rate changes as we go through the year. So right now we're still hovering in that 5% mark. Some good loans, you're still in the 4%, some bumping up into 5% now. By the end of the year, you know, that's going to go up some. So now's a good time to, if you're getting loans, now's the time to get those if you can get them. Because again, it might not seem like a lot if it goes up just a 0.5%, but that could be a couple $100 on your loan every month. So as far as last year, let me give you a few. I'll just give you a year end. So we do 6 counties. We have Lake County, Newton County, Jasper County, Porter County, LaPorte County, Stark County. I may be missing someone. But of our 6 counties, year to date, now I don't have December's statistics yet. I won't get those till the end of this week. But from January 1st of 2018 to January 31st of 2018, in all our counties, we did, units sold. Oh, I'm in January. That's not going to work. So as of November, excuse me. So from January 1st of 2018 till November 30th of 2018, total units sold. Now this is just single family, condominiums, townhomes, duplexes, not including any new construction. We sold 10,139 units at a median selling price of $164,900. So our median selling price went up 7.1% over the year. It's a pretty good return. Now, of course, some areas did a lot better than other areas, but all in all, I think all counties did really well in increasing their overall sales. Of course, those prices, for the most part, increased. Some areas we did see some downs. LaPorte was down a little bit. And then some areas in Stark County, Jasper County, those were down a little bit. But overall, we had a great 2018. And with that, we did a lot of activity. I think this year, again, it's going to be a great year. I think you'll have a little more inventory available to you. I think you can get back to a little bit more, as everyone says, bargain prices. Just depending on what you're looking for and how much time you have to, you know, if you're looking to have something now, it might take a little longer. If you've got a little bit of time, if you're willing to hold out and look for what you want to have, you might have a little bit better luck with it. But all of all, so far, January has been, I've been having a great January. I see some other faces in here that I know are realtors, and I'm pretty sure they're probably having some great Januaries too. Our buyers are still looking. So if you have things that you're waiting to get on the market, get them on the market. There's not a lot of competition right now. It's the best time to get your money is when there's no competition on the market with you. So again, for 2019, I would say we'll have a fairly good year. Again, those prices aren't going to be as crazy as they were last year. I know we were selling $20,000, $30,000 over asking price on a lot of these homes. Appraisers were starting to get a little irritated with us by the end of the year. So this year, I'm hoping that we can keep it pretty straightforward, pretty close to what our asking prices are. So when buyers come in, they're not having to figure out other ways. So when the house doesn't appraise, and we're saying we're $10,000 over what the appraisal value is, I know we were having a lot of scrambles on, well, we really want the house. How do we make this work? So you either have to invest your cash into it, you know, get the seller to come down. A lot of different ways we can make it work. But I'm hoping we don't have that issue this year, that, you know, it's a little more straightforward in our closings. Other than that, I don't know if there's anything specific, if anyone has any questions for me. Sure.
Also in the rental market?
I do not have those stats with me. I would have, and the reason being,
Just a general impression, though, what would you say?
rentals were huge. I mean, I know I had a lot of calls on, can I get a rental? The problem is we didn't have the inventory for the rentals. And then the prices just, again, I think they hit kind of top of market. I mean, we were talking $1,600, $1,700 for some of these homes that, I mean, I thought, wow, that's kind of crazy. I can easily sell you something and get your payment down. But yeah, I mean, in some cases, not everybody can qualify to go ahead and buy, so they needed rentals. We're still needing rentals. We'll always need rentals. Now our MLS, not everybody puts rentals in the MLS. Personally, myself, I don't believe in rentals in the MLS. I don't want to deal with an rental as an agent. Now, not working as an agent, just a person coming in, you know, wanting to do business, get a rental from me, that's one thing. I'm not a big fan of that. But we do have a lot of agents who do work with rentals. And I'm getting questions every day. We have our own support page that we have, and it's like, hey, where can I get this? I need this for my client. Some of the issues too are pets. Not everyone wants pets, and everybody wants to have their pets with them. And they promise you their pets are not going to pee or damage the house or what have you, but we all know what the truth is to that. Although I will say, and I don't want to offend anybody, but sometimes kids are worse than animals. So, you know, pick and choose as you will. But, you know, I don't know if I would have to go back and look. Like I said, if I had statistics for rentals, I would say we did pretty well with the rentals overall in general. Of course, summer months are always a huge hit because that's when people are, you know, changing school districts if they need to when they're moving. Valpo was a big one for rentals. Portage, Chesterton, I'm sure out towards Cherville, Dyer. I'm typically out towards Stark, Jasper, Newton, LaPorte counties. I tend to go that way rather than come this way. But I've grown up in the area. I've lived here, you know, my entire life. So I see it's changing. You know, if you're going to have a rental, now's the time to do it. Sure.
Those 10,000 units you mentioned, is that just listing leaders, or is that based on?
No, that's the entire Denier MLS system.
And how does that compare to the year prior?
I can tell you.
Thank you.
So from November 1st, 2017 to, or excuse me, I want to do January. January 1st, 2017, November 30th, 2017, units sold were 9,929 at a median selling price of 154,000. So we were up 2.1% on the number of units sold and up 7.1% in the selling price.
Very good, thank you.
You're welcome.
Amazing. monthly reports are on GNR that are open to the public to go in and see, right?
You know, I would have to look, I'll be honest, I'll have to look at that. I mean, even for me, when I'm trying to pull the stats up in GNR, sometimes I'm like searching in all these boxes. Since I am on board of directors, I immediately get those sent to me every month. So I always have the stats. If you have a question, I'm more than happy to help you. I have some cards on the table, I'll be in the back. If you want to give me your email address and you have specific things you're looking for, I'm happy to look it up for you and see if I can find that information for you.
And I am pretty sure these reports are available to the public if you go on GNR.
And it is a national average. I mean, we did pretty well. I mean, if you go in, you can go to nar.org, and that can give you stats for the nationwide. We had a lot of jumps from Illinois over to Indiana. They went into Ohio, or into Wisconsin, up into Michigan. With the taxes as they are in Illinois, it's been a mass exodus, if you will, from the state. And then GNR itself, we're doing a whole advertising campaign now. Grass is always greener on the other side. To move more, we concentrated a lot on having businesses come on into Indiana, but we're trying to get the people into Indiana too to help our economy and grow us. So, and then again, there's a lot of things to take into effect coming up this year. One thing I will mention is many of you may or may not be familiar with Whiting and what's going on with their soil up there. We have found lead in the soils in Whiting. So if you are looking to be in that area, just make sure you do your due diligence. You know, look up on those properties and see if it's actually going to be a good deal for you to be going into that area. I would stay away from it personally myself, but again, everyone deserves a home and they need to be somewhere. So if it works for you and it works for your client, go for it.
Thanks for your insights. Again, if you have any questions, you can catch Allison after the meeting. She has all sorts of stats that she can fill your analytical mind with. But I'm going to bring Josh up now. I'm excited about this talk, partly because I like taxes and I like number crunching and I am analytical. But if you're on our Facebook page, we get questions all the time. Hey, who's a good accountant? Help me with this tax issue. How do I skimp a couple of bucks here? And I've talked to a lot of people that have skimped a couple of bucks, and it turns out because they didn't get good advice, they actually lost in the long run. So I'm always emailing Josh, hey, what do I do in this situation? What's the best way to structure this? He sets up all our entities, so they're set up in the appropriate tax structure, which at the end is going to save us a bunch of money. So if you want to welcome Josh, come on up. All right, turn off and you can turn on.
All righty. Well, good evening. How are we doing? Good. That was pathetic. All right. Yeah, it's usually the response that I get as an accountant. I think it was the first time in all the times that I've spoken that I had to follow a statistician or somebody who geeks out statistics like that. That was awesome. So that was good information. So let me go ahead and I'll put my legal slide up here. So basically, anything I say, don't believe it. You try to sue me, my lawyer meaner than yours. So basically, that's what that says. Okay. When Adrian, first of all, please, I know there's a lot of people in the room. I have a few clients in the room, a few friends, actually a family member or two, and two ladies who I don't know, you right here and the lady that stood up earlier. I already like you two because you have Purdue. I noticed that when you walked in. So we had the Purdue IU rivalry over the weekend. I'm a Purdue alum a couple times over. And the wrestling team beat IU on Friday night, men's basketball on Saturday, ladies won on Sunday, clean sweep, boiler up. So had to get that out of my system. I don't see anybody, which I like, that has an IU anything on in the room, so I appreciate that. So I will have a petition at the door when you leave. We are going to see if we can rename the state the Boilermaker State. Can anybody tell me what a Hoosier is? Okay. Adrian, when he sent a little blast out there in regards to some of the things we're going to talk about, this actually, I've given this talk a few times. I went ahead and added this in. This is something that's a little bit confusing. All I was going to say, if you want to interrupt me, please do. But you'll have to bear with me. If I don't know the answer, I'll make one up. Okay, and hopefully it sticks. And for those of you who've heard me speak before, sorry, I don't have any new jokes. They're pretty lame. So, okay, in-service date. Probably about a year or so ago, a publication I imagine for those of you who are real estate investors read, there was an article on this topic that was a little bit wrong. I mean, blatantly it was wrong. And so I want to kind of touch on this. It was actually kind of a hot topic issue in regards to when you can start depreciating a property. And I'm going to get through this, and then we're going to get into some of these tax law changes. And there's a lot of information here. I tried to kind of truncate this thing down into kind of just some really high-level stuff because I don't want to bore you guys to death because it's just kind of a tedious topic. Usually taxes, anything, it can be rather boring, but it's incredibly important, both from a compliance end and also for your pocketbook. And with this sweeping change that we had take effect last year, there's a lot of things that, to be honest with you, even people in my world are still trying to figure out. And there are still things that we don't know. There are still parts of these tax law changes that we're just going to have to wait and see what happens. And with this government shutdown, we're still waiting for a lot of things, a lot of answers. And I'll talk about that a little bit as we go through this. And right, wrong, or indifferent, I'm not going to make a political stand on this. Bottom line, the reality is that there are sweeping changes. We need to kind of understand what some of those are, and then I'll try to help a little bit as far as maybe how it will impact you as we move into now what, for us accountants, it becomes tax season, and for all of you as we begin to compile your information, get everything ready to take to your accountants here in the coming months. In-service date. So one element when you buy a property that you have to deal with is when can I start depreciating this? And this particular article is a little bit off base, saying that, well, whenever you start advertising a property, you can start depreciating a property. Now, when you buy give a little background here, when you buy a property, if it's residential real estate, essentially you have to depreciate that property over 27.5 years. So say you go through and you buy a property for $60,000, you put $40,000 into it, you're going to turn around and rent this. So my property value, basically my cost is $100,000. So you're going to take part of that $100,000, it's going to be a portion to land, and the rest of it you have to depreciate. I can't fully expense it in 1 year. Okay, I have to write it off over 27.5 years. If it's commercial property, that has a timeline, a depreciation timeline for tax of 39 years. Okay, and so there's a time when you can start depreciating this property. And so when you buy the property, unless you're purchasing it as a turnkey, there's a tenant in it, you cannot depreciate it from day one. When you get to the closing table and you sign the closing docs, you cannot start depreciating that property then. So you go through and you go and you sit down at the closing table, you sign the paperwork on this property, and you're spending $60,000 on this property, knowing you're going to have about $40,000 in rehab. So you go through and you purchase this property, and you begin the rehab process. Okay. At the point that you finish the rehab, and you begin to advertise the property. So let me mention this here. So this IRS publication, and this was as a result of a lawsuit on this particular issue that went to the tax court. They came up with this publication this last year, as far as when can you start depreciating a property. A property is placed in service in a rental activity, and here's the quotes came right out of the IRS publication, when it is ready and available for specific use. And so these terms had to be defined. So it being ready and available. So it being ready is one thing. Okay, so it being ready means it's fully rehabbed, it is ready for a rental. But it does not necessarily mean it's available. So what's your name, sir? Hector. Okay, so Hector. So I have this property, and I go through and I purchase it, I have it rehabbed. Okay, and there's somebody out there that may want this property, but I haven't told anybody. Now Hector may be very interested, but he doesn't know that I have the property available. I haven't made it available. Okay, I have a finished product, but I haven't made it available. So that's a second piece of it. So when I go through and I finish this rehab, and so now I have $100,000 into this property, I finished the rehab, and it is now ready. Okay, it is not until the point that I've made it available, that I've gone to the point of actually advertising the property. So my timeline, I buy this property, and I bought this property last year in November. Okay, I finished my rehab in December. Okay, so I went through, bought the property, finished my rehab, and I don't start renting it until March. Okay, if I never did any advertising, I can't start advertising it until March. But if I finished that rehab in December, and I went through and I started advertising, however you go through and you market the fact that you have a rental available to be rented, at that point you can start depreciating. So that's something you want to kind of keep in mind, especially when you get into the point of getting closer to your year end, and maybe you want to start capturing a little bit of the depreciation, and then we'll talk about a little bit of items you can possibly accelerate in depreciation that may be beneficial for you on a tax end. So these are important dates, important events that you need to kind of keep in the back of your mind when you're going through, and if you're in the rental space, whether it's commercial, whether it's residential, kind of just some basic facts you want to keep in the back of your mind when you can actually start writing off this property that you've dumped a lot of money into. Okay. So in-service dates. Any questions on that? Okay. Okay, Tax Cut and Jobs Act. This is where, and there's a lot of information out there in regards to this. And so I'm going to try to be as basically as simple as make this as simple, like a little bit of a complex topic, make it as simple as I possibly can. Some of the changes, and then I'll get into some of the direct real estate, and then I'll kind of open the floor, maybe just for some direct questions, or maybe specific questions that you might have that possibly I can help with. So some of the changes. One of the big changes is the top item here, charitable contribution. All this is on what we got Schedule A. You guys kind of picture your tax returns. You have this 2-page 1040, and then there was a Schedule A where you would traditionally itemize, and probably for many of you in the room, if you own a home, you probably itemize. So you had combined, if you had a lot of medical expenses, you might have had some medical expenses, then you had your state and local income tax deductions, and then charitable contributions, and then you had these 2% miscellaneous items down at the bottom. So in the past, you just had your standard deduction. Usually, if you're married, it was right around $13,000-$14,000, somewhere in that ballpark. Then there were exemptions. You had kind of all these components. Well, a lot of that has changed. So exemptions have now been removed, and so now you have kind of the standard deduction, which is essentially about double. It's $24,000 for a married couple, $12,000 if you're single, okay, $18,000 if you're head of household. And then remove the exemptions. So if your itemized deductions are over now, and starting in 2018, over that $12,000, $18,000, or $24,000 mark, you would itemize. So a lot of people now, and the number is right around, the number before was about 70% of people would itemize. Now the number is probably going to be 90% plus that will end up using a standard deduction, completely flipping everything on its head. And so so a lot of people now will just take the standard deduction, which will be that $24,000 if they're married. But for some of us in the room, if you're very generous, very benevolent, have a lot of do a lot of giving, you may end up tipping over into itemizer if you live in Illinois, a higher tax state. You may end up or live in a more expensive home that you might have higher interest and property taxes. You may still end up itemizing. So with that, one of the changes to the charitable contribution, it used to be historically you could deduct essentially 50% of your adjusted gross income, up to 50% of your adjusted gross income. So say for example, your adjusted gross income was $100,000, you could deduct your charitable contributions up to $50,000. That number now is 60% of your adjusted gross income. Doubling of the Section 179 deduction. Now, a lot of the Section 179 has been deemed unnecessary because of the next item that we'll talk about here. But the old Section 179 deduction is still there, is you can make an election on certain classes of property to write the property off completely in 1 year. For example, maybe a computer, okay, or maybe a more expensive item, such as a vehicle. Okay, certain things like that you could directly write off in 1 year using a Section 179 deduction. There were ceilings as far as over a lifetime that you could write off. But now that number has been doubled. So the double of Section 179. So from $500,000 to $1 million that you can write off, and then there's a phase out that goes on above and beyond that. Next, bonus depreciation on certain assets. Now, assets are broken into different depreciation classes, and so there you have 5-year assets, you have 7-year assets, you have 15-year assets, and I'll also offer this. If any of you guys want these slides, just send me an email. I do have cards here. Find me on Facebook. Send me a message, whatever the case may be. I'm probably friends with a lot of you I know in the room on Facebook already, but just reach out to me. I'm more than happy to send this via email to you. But the bonus, so the bonus depreciation on certain assets went from 50% to 100%. So you have these different classes of assets. So you have 5-year assets, you have 7-year assets. I'm not going to go into as far as what falls into those things, but they're shorter term type assets. So it might be machinery, equipment, things of that nature. And so now those can be fully written off in 1 year, provided that you have a written policy. So if you own a company or you have a real estate entity, an LLC, something like this, you'll want to have a written policy that states we write all assets off fully in the first year, okay, up to the $2,500 mark. So before, for somebody like myself, it's real tedious. We have to pull apart, somebody goes and buys a $1,200 laptop, for example. And we have to go through and, qualify for 50% of the bonus depreciation in the first year. And we have to carry the remaining balance over the next 4 to 5 years. Okay. Now it completely removes all that headache. So now you can write off a computer fully in the first year. Okay. So it kind of helps as far as both increasing the amount of expenses you can take for certain smaller asset items that you purchase, and it makes things easier from a compliance and paperwork end as well. So bonus depreciation on certain assets, and I mentioned the safe harbor, $2,500 or $5,000 if your financial statements are audited, which usually in the real estate space we don't see that too often. Businesses with audited financial statements. This next section is the section that which is section 199 of the IRS code. Okay, so here's the section 199A, which is what it's replaced with. This was the biggest sweeping change it's going to relate for anybody in the room here who has any sort of active business dealings. And I'll mention that real estate can qualify, and I'll mention why here in a moment. But historically there was this VPAT deduction. It stood for the Domestic Production Activity Deduction. It will be included at the end of this. So there's this VPAT deduction, and what this deduction was, it was primarily used for any company out there that produced something. Okay, and generally, in the original intent of this particular portion of the tax code was really geared toward manufacturing. So basically taking raw material, doing something with that raw material and generating a finished product. And so there was a deduction that went into place as far as all the costs that went into taking raw material to a finished product. But actually this ended up trickling over into anybody who bought real estate that needed to be rehabbed and then sold. So the same philosophy was able to be applied there. But that particular section of the tax code has been repealed. So it's no longer there effective January 1st, 2018. And so now it's been replaced with this QBI deduction that I'll talk about here in a moment. That probably, if any of you at all follow as far as what's going on with tax law changes, you probably read a little bit about this. It is very complex, and we're still awaiting, even though we did receive huge directives on this in October, we're still actually waiting, and whenever the IRS decides to reconvene, as far as more directives coming up here in the next month or two. So the repeal of the VPAT deduction, and then business meals, no entertainment. This here is a slide that I've shown a few places as far as, and I know you can't read this, but as far as what the old rules versus the new rules. Basically, entertainment has been removed. So if I decide to go and take someone out golfing, for example, okay, and we go and we play a round of golf or country club memberships, you go to a bowl game. Somebody here said they were a White Sox fan. That's not entertainment. That's depressing. A Cubs game, okay. Sorry, I'm sorry. But if you decide to go to a Sox game, Cubs game, whatever the case may be, that's no longer a deductible expense. Okay, that's considered entertainment. But meals still are, and there's some creative ways to get around that. I'm not going to get into that into this room, but so entertainment's been completely removed. Most meals, as they always have been, are still 50% deductible. Where the change has been as far as if there's on-site. So there are some larger corporations out there that have like on-site cafeterias, things of that nature for the benefits of their employees. That's now 50% deductible. Or if you bring meals on-site for a meeting, things of that nature for your employees, those used to be 100% deductible. Now those are only 50% deductible. So those are kind of the two biggest areas of change as it's related. No more entertainment, and then how the classification of meals as far as on-site or near the site of your business as it relates for the convenience of the employer for the employees. Okay, Adrian, yes, sir.
When it comes to meals, I understand the 50-50. If I'm taking care of out, I'm deducting per part, but not my part. What if I'm taking like 3 people out and I'm just 1/4 of that meal? Is it still 50-50?
That is correct. Yes.
Okay.
It is.
Hey, Josh.
You made it. I didn't think you were going to make it. Good to see you. Yes, now. You're
You're
not allowed to ask questions. You got a T-shirt. You have to leave. All right.
No, I got a book.
Oh, you got a book. Okay. You don't even know how to read. That's impressive.
Is there a certain mile radius though for the mills, right? It's got to be outside of 100 miles from your home.
No, not at all. It's kind of a little caveat in there as far as it's kind of near, but basically just bottom line. As far as the convenience of so if you take your group and you go down you know, a couple buildings down or you go 10 miles away, the same rule applies, it's just gonna be 50% deductible. It used to be what happened is that, and, probably doesn't really apply to anybody in the room, but some businesses would contract with a cafe, a couple buildings down, wherever the case may be, you have meals catered in every day, or their employees could go there. That's where that little caveat came into play. Okay. Yes, sir.
So if I go looking at properties and I buy myself lunch while I'm out,
Not
it's
deductible.
not deductible at all, regardless.
Not at all. You have to have somebody with you. Yes. So if you need somebody to go out to lunch, I'll go with you. Yes, sir.
So if I go, like, say, suppose I go to the Caribbean, and then I ask for, like, I'm going to look for some properties, you know, just, you see some nice condos, you know, you see some nice condos, and you say, hey, I'd like to take a look and see what something like this costs. Is that anything, even though your real estate business in the States, can that be part of your business?
The rules there are a little bit complex. So the intent of the trip would have had to have been to go there, first of all, and a majority, or to conduct business, number one. And I do some traveling in my business. I have I think 3 trips coming up here in the next month. And so the intent of those trips primarily, and I'll give you an example, I'm going to Dallas here in a couple of weeks, and I'm in a mastermind group down there. We're meeting with the clients as well. As while I'm down there, I'm bringing my wife along with me. And so when I go down there, I'm not spending every day on business. Okay, I'm going to take one day, and Angie and I, my wife, Angie was here with me, we're going to spend a day in Dallas, a day and a half, whatever, just going and doing whatever we want. Okay, so it's going to be personal, but a majority of the trip, the other rest of the time we're down there, is going to be business from the, for most of the days while we're there. So the intent of the trip is business. I can write the entire thing off. Okay, but if I were to go down there, I happen to be conducting business, you know, for a few hours, 1 or 2 days, but I'm down there for 6 days, then no, I can't. I actually have to prorate, or essentially kind of apportion the expenses. So a majority of the trip, and generally kind of the 3/5 rule kind of applies here, but a majority of that trip needs to be for business. So you can't say, well, I'm going to the Caribbean and I happen to go and spend an afternoon going and looking at properties. That wouldn't fly. Now, if you took part of that day and you drove out there, took the mileage and that type of thing, those direct expenses you could write off. Okay. Yes, sir.
Let's assume you have a property in Florida as a rental.
Mm-hmm.
Would you be able to deduct that then? If you flew down there, you'd be able to deduct everything, right? Meals and everything, because you're not around.
Provided you went down there to work and actually,
yes.
Yeah. Okay. Just to go down there, having to drive by and look at the property one afternoon and you speed by at 80 miles an hour and wave.
No, but if you came in, you spent washing windows or something.
So if you're actually going down there, you need to document this too.
Yeah, right.
So when you go down there, you need to document, and a lot of times where, little day planners, Google calendars, whatever you use comes into handy, especially in an audit scenario. They want contemporaneous logs. IRS wants that word contemporaneous, detailed log. And so when we go into audit representation, that's something that becomes.
But the meals and everything are covered then, correct, since you're out of your home?
That is correct. Okay. Yeah, provided it's not considered a second home or something like that.
Sure.
Yeah, sure.
Right.
Correct, yes. Credit card statements are never permitted as far as for deductibility. You always have to have the actual receipt. So you go through and you went to the restaurant and you bought something, your credit card statement does not substantiate. You need to have the receipt. Okay. There is a rule as far as under $75, you don't have to have the receipt. If you have, but you need to have a written policy, and it gets a little bit complex. So the bottom line is just advise my employees, regardless of the amount of the receipt, this day and age of technology, you snap it with your phone and automatically store it. Just use the technology that's out there, scan it, keep it. Okay. All right. Where was I at here? Okay. Next change here. I guess it's the thing here, didn't I? Yeah. Okay. So long-term capital gains now taxed at either 0, 15, or 20%. So there's been a push down as far as on the capital gains where it affects people. So there will be situations where people may have some long-term capital gains and not pay anything. Okay, if they're married, their adjusted gross income is under the $77,000 thereabout number. Okay, 15% rate between those with income between if you're single 38 and 425 and 77 and 479 if you're married. Which would probably be, I would imagine, probably most of the people in this room fall in that particular category. And then if you're above that, like my brother-in-law Jared over here, multi-millionaire, he'll be at the 20% rate. Okay. All right, and tax brackets have been lowered, no more recharacterization, so you can't go from a raw factor to traditional, I'm not gonna spend any time on that, but 529 plans can be used for elementary and secondary ed. Just information here, just to kind of, in the back of your mind, things that you may want to use as far as in your tax planning strategy. Okay, pass-through deduction, this is where I think for most business owners, people who have things going on outside of just a 9-to-5 W-2 JOB going on. Okay, so for those of us and myself, I haven't worked for somebody else in many years now. Okay, I've owned my own business, and same thing. My wife, with the exception of for a few months out of high school, she's owned her own business the entire time. So kind of we're entrepreneurs, love starting businesses and working with business owners, for people like us, and for like many of you in this room, who go out and kind of generate your own wealth. Okay, so you kind of go out and you're not relying on somebody else to sign the bottom of your paycheck. Okay, there's kind of a little bit of reward here. Okay, from a tax code perspective. So for those of us who are going out there and we're actively earning our own wealth, making our own money. Okay, there is now this pass-through deduction. And so let me kind of spend a little bit of time on this and try to make this as understandable as possible. Okay, like I said earlier, we're still waiting for a lot of directives on what ultimately this is going to look like, but we have a pretty good handle on what this ultimately will look like. So the pass-through deduction for qualified business income from a qualified trade or business. So the question becomes, what is a qualified trade or business? Basically, a qualified trade or business is any business that is, one, active, and number two, does not rely on the sole skill set of its owner. Now, unfortunately, I'm an accountant and specifically excluded from being able to take this deduction if my income's over a certain level. Okay, but for those of you in the room who are real estate investors, active real estate investors, there is no ceiling for you. So it doesn't rely necessarily on your skill, but there are certain licensed trades, such as my trade, that have been specifically excluded. Certain types of consultants, accountants, attorneys. For example, we have, once we kind of hit a $350,000 income level, we can no longer, there's a phase out, and we can no longer take this particular deduction. But for most of you in this room, this will not apply. Okay. So, Internal Revenue Code Section 162 defines a trade or business activity as income or any activity or income or profit in which the taxpayer is involved in the activity with continuity and regularity. So something that you're continually doing and regularly doing. Okay. And qualified income generally excludes capital gains, dividends, and interest income. Okay, obviously these are traditionally passive types of revenue streams. It also does not include reasonable compensation, either a guaranteed payment to the taxpayer, and I'll explain that a little bit more here in a minute. So as far as in the calculations, there are certain things that are backed out to come up with this deduction. And there are certain things that are excluded. So if you have a business and there's some interest, some capital gains, and there's kind of this active component, the parts of it have to be peeled away. So it's just some issues here before I get into a little bit of detail, and then I'll actually give you a couple examples here to show you kind of the complexity of what this looks like. But issues, first of all, active involvement with rental income. And so one issue here, and something you need to be aware of. For any of you in the room that have rentals, if you are actively managing your own rentals, so if you're not taking your property and having somebody else managing them, you're managing themselves, you're self-managing, then it qualifies for this 20% qualified business income deduction. If you hire somebody, we have some property managers in the room, including a few clients that do that in the room. Okay, but if you hire a property manager, or if you have a structure to where you fully own a property management company and you fully own an entity that has all of your rentals in it, okay, so even though you're self-managing, but you're not managing within the same entity, the same rule applies. It's considered that you're not self-managing, okay, under this definition, so you would not qualify for the deduction, because at that point it's not considered active, because you have hired somebody else to bill for the rent, to collect the rents, to manage the property for you, and become hands-off. Okay, so that's one thing you need to think about. If you have a rental portfolio, if you're having somebody else manage it for you, of course, there's a huge benefit to managing properties, right? You kind of remove yourself from all the brain drain. Okay, that kind of goes into play there. However, you need to realize that it's also going to come at a cost, meaning that you're not going to be able to take the qualified business income tax deduction for that 20% QBI deduction. Does that make sense? Comprehensive? Yes, sir.
So the 20% QBI would be like off the K1 as opposed to...
Right. Let me explain what that looks like. And I have examples here. But what's your name? Jeremy. Okay. So to answer Jeremy's question here, yeah. So basically, what happens is, and you mentioned a K1. I think most of you are familiar with what that looks like. What you get from a partnership or an S corporation, for example. So what would happen there is if you're under, I'm gonna say you're under the $315,000 threshold. So you have this business, okay, and so you grossed $1 million, you had $500,000 in cost, another $250,000. So your bottom line is $250,000. Okay, the QBI deduction in that case would be 20% of the $250,000. And so essentially what you would normally see in kind of box 1 of your K1, okay, that number is 20% of that number. To make it a little bit overly simplistic right now, but that's essentially what it looks like. Okay, so that bottom line on your 1120S if you're the 100% owner, or box 1 of your K1. Okay. So active involvement, rental income. Of course, if you're fixing and if you're purchasing and rehabbing and selling properties, of course that's active. But rentals is always kind of the big question. Can that qualify for this particular deduction? And it can, provided that you're managing it yourself. Number 2, salaries for S corp owners, and I see this unfortunately too often, to where people go and they set up an S corporation, but they don't take a reasonable salary out of their S corporation. So they try to set this thing up to take tax advantages, but they don't work on the compliance side. Okay, so if you're not doing that, then you're going to run into some issues with the QBI deduction. The IRS is going to catch that, and you're going to have some issues. So there is kind of a catch there also with the compliance side that the IRS has put in here. So if you have an S corporation out there and you have rentals, you should not be doing it in an S corporation. And I won't spend time here, but if you have rentals, you're doing that in a single member LLC, you're doing that in a partnership environment generally. Okay. So in those scenarios, you would not be taking a salary, you would not need to. But if you have an active business, you're operating in an S corp, you as the owner, even if you aren't necessarily all that actively involved in it, you still need to, for compliance purposes, make sure you're taking a reasonable salary out of the business. And especially if it's a high earning company, you're going to need it because it's going to be one of the qualifiers that's there for the QBI deduction for that calculation. And lastly, capitalization cost. And this has always been an issue, but it's even more so an issue now. If you're over that $315,000 threshold, is because there's also a computation that comes into play as it relates to your value of your assets on your books. And once again, I'll get to a real example here in a second. So the 20% deduction on earnings, so it's basically 20% on the net income of the business, or on box 1 of your K1. That's an active business that you're in. Okay. On earnings, unless over the income threshold, and then there's this complex calculation. I'm not going to spend a lot of time on this, except that you need to be aware of it. So there are two basic, there are basically two other calculations that come into play that is compared with it. Okay, one is 50% of your basically of your wages that's paid out of the business, or 25% of your wages plus 2.5% of your basically your capitalization cost. So the portion of your assets that you're depreciating. And I was on the phone with Wayne was in here. I was on the phone with him last week, and I kind of quickly just ran through this and made both of our heads hurt. But so it gets really complicated. Okay, but these are things you need to be aware of because these are conversations you need to be having with your accountants, especially if you're over these thresholds. And I hope for most of you in the room that you get there, if you're not there already. But you need to have that dialogue. Okay, am I setting this thing up right? Okay, am I making sure that I have my wages where they need to be? Am I making sure that I'm depreciating things most effectively in order to be able to take advantage of this particular deduction? And so here are some basic examples, and I don't want to run through this, but this example 1, they have income of 310, so we're under the 315 threshold. They have some capital gains and whatnot, and just basically how it comes to the calculation. So their taxable income 310, the 10 of it is capital gains, 280 is ordinary net income, so it's under the 315 threshold, which is 20% of the 280 is their deduction. So basically what that means is that they're 20% of their income, they're not paying taxes on it. Okay, so it's just a pretty nice deal. Next here is would be somebody like myself. okay? To where, if I'm over that threshold, now all of a sudden, I can't get the deduction because I'm over the $315,000 threshold and I have a specialized skill, okay? That's particularly excluded in that as being an accountant. And apparently we didn't have enough lobbyists in the room when this bill was written, I suppose. And then this next example here, of course, they're over the threshold, and we have all these other types of revenues coming in, and then we have to do this big, huge calculation. I could spend all night going through this, and I don't even know if I necessarily be able to understand it myself, right? But basically, these are the types of things that geeks like myself are going to have to do sometimes with clients. We're going to have to go through all these calculations to come up with what is the actual deduction. Okay. So bottom line, takeaway on this: if your income is under $315,000, you're married under $315,000, you don't have anything to worry about this year. Okay, but obviously if we're planning for the future and you're saying, okay, well, I'm not going to mess with this because I made $280,000 a year, but you might be there next year. You need to kind of make sure that you keep your, you're having this, like I said, this dialogue with your accountant, make sure that things are set up correctly, both from a compensation end and also from the capitalization, or basically what you're depreciating on your property. So the apportioning of land versus your real estate, how much cost segregation do I do, things of this nature, because they are important. Okay, cost segregation, something I get questioned on a lot. Cost segregation, most of the time in single-family homes, is not necessarily worth the cost. It can be on larger real estate projects. I have a client up in Milwaukee, a huge development project. Been working with a developer up there and some investors that went in and bought a property. And so this conversation there would be realistic. It was the development of an old a historic property, and so it made a lot of sense to go through and consider going through and cost segregate. What is cost segregation? Normally when you go through and you buy a property, you're saying, okay, well I bought this property, I rehabbed it, and so here's my end cost, I'm depreciating the whole thing over 27.5 years. Okay, cost segregation would go in and begin to pull apart individual costs. So they would, so basically, an architect would go through and take a look at the prints and say, okay, well, we're going to determine that the carpeting is about this much, certain electrical components are this, and so which can be depreciated over a shorter timeline. So I can boost my depreciation in sooner years instead of taking the entire project and depreciating over a 27.5 year or a 39-year timeline. So basically, it's a way of kind of shortening some of the depreciation timeline, but it can be expensive. So sometimes it does make sense when it is when it's a larger project. Okay, so like when I was talking about is phase one was $7 million and up to about a $40 million project when the whole thing's completed. Okay, so in that situation, it would make a lot of sense. Okay, whereas if you're buying single-family homes, it may not. However, it is important when you go through and you purchase a home, and maybe there are some appliances in there. It may be a good idea to go in there and either with your accountant or somebody who understands, or even with somebody who understands construction, take a look and say, okay, well the carpeting is about 3 years old, and begin to make a determination on what would basically be the fair market value, for lack of a better term, of the carpeting that's in the house. Definitely appliances, okay, things of that nature you may want to pull apart instead of just throwing everything in 27.5 year timeline if you need the depreciation sooner than later. You do need to review your tax structure. This should be something that, and Adrian mentioned this earlier. And Adrian, I don't have an idea where I'm at on time, so just throw something at me, yell at me, whatever, if I need to shut up. I have my wife here. She's good at that. So she gets tired of hearing me talk. So I was surprised she came tonight. But you do need to review, make sure you're reviewing your tax structure, not just from a tax end, but also from an asset protection end. Is what you're doing true? Does it truly make sense? Review your payroll and owner compensation, because if you are over that threshold, it can be very, very important. Okay, that's structured correctly, and then I mentioned this apportioning land and structure values. So that's kind of the end of what I have here. I can talk on a lot more about a lot of these things in tax. One thing that Adrian mentioned as far as or what are things you can do. I know we're into 2019. What are some things you can do to kind of lower your 2018 tax liability? And a lot of times these things are related to if you want to consider using a traditional IRA, not necessarily something I would always recommend, but of course that's always there if your income threshold permit it. Or I'm sorry, There is no income threshold with traditional, but if you have a W-2 job with a 401k or something like that, it could be limited. But if you own a business, maybe if you utilize a SEP, a simple plan, certain things of that nature, you can still, up until the time you file a tax return, the tax return of the business, you can still contribute money into that, get a deduction for the prior year, and also some of those things can also be a business expense. So there's not really at this point a whole lot you can do directly except for in those avenues. But one thing that you definitely want to do if you purchased properties last year, as far as working on the land versus the capitalization cost, those are things you can always do. That's not something new to the tax cut, the new tax law changes, but something you always want to kind of stay on top of. And spending the time, if you need to go back and say, okay, are there certain pieces of this I can depreciate or expense, either expense directly or depreciate over a shorter time period if indeed you need the deduction in a given year. Okay. Is there anything else that you wanted me to touch on before I open the floor up for any questions?
If we don't have anything else, I think Q&A will fill up some decent time.
Okay. What can I help you with? I'll start over here first time. You're already taking me to the Caribbean. You're already.
What's your take on series LLCs? I know Indiana passed that last
I'm sorry, what's that?
Series LLCs.
Yes.
What's your take on that? What would you recommend as far
Well,
as
anytime there's
anything
anything
LLC versus series LLC?
Yeah. So anytime that there's a change, and of course LLCs are relatively new, probably within your career, right? It's something that LLCs didn't exist not too many years ago. So at first we didn't know, even when they started coming into states, how they would play out in court. Okay. And so anytime there's anything new, we don't necessarily know how they'll ultimately play out in court. But we're going to assume in Indiana, series LLCs are going to, from an asset protection end, they're going to be handled the same way as other states have handled it. So there are different, of course, it can be a more inexpensive way of going through these series LLCs, and a lot of it just has to do purely, all series LLCs do nothing for you from the tax end, it's purely from an asset protection end. Because the master LLC is still going to be your determination on taxation. So just for a point of clarity here, the IRS does not recognize LLCs as taxable entities. You need to realize that. So the IRS looks at an LLC either as a disregarded entity, single member LLC, okay, as taxed as an S corp, as a partnership, as a trust, or as a C corp. Okay, so it's basically one of those 5 things. So that's the way the IRS looks at the LLC. So from a tax end, the IRS is still going to look at this, even though you have a master LLC and all these series. The IRS is still going to look at it. What is that master LLC's taxation? Then with the series, it's just a way, instead of setting up multiple LLCs, you can do all these series LLCs if you have, for example, a rental portfolio or different types of revenue streams that you have going on. That in that area might make sense. One thing I want to mention with this, if you have multiple types of revenue streams in your business, you need to make sure your bookkeeping is there to the point to where you can pull apart your active versus your passive revenue streams. So if, say, for example, you're investing in notes, okay, in part of your portfolio, purely passive, okay, and then you're doing some wholesaling, and you have some rentals, okay, there's going to be some apportionment of these expenses that's going on, okay, in order to be able to determine this QBI deduction. So that's another probably conversation you need to have with your accountant, how your books set up to make sure that that they're structured in a way that you get the most out of that QBI deduction. My Caribbean friend, what was your question?
Is there a difference when you? Is there a difference between leasing a car or renting a car as far as write-offs? As far as taxes, is that looked at differently, or is the same deduction? Is it 50%, 100%, 75%?
The lease versus purchase rules. Here's the thing: if you're we said the word lease versus a purchase. Okay? Rental. Right. Well, if you rent a car, okay, it's basically just going to be always be the comparison of your mileage versus your actual cost. So you're still going to have to keep track of your miles, and you're still going to have to keep track of your actual cost, regardless of what you do. Now, as far as the leasing or purchasing a car, okay, that there becomes into the same rules are going to apply. If it's a vehicle that qualifies 100% for business use, meaning it stays on site at the location, no commuting miles, you're not driving back and forth from office to work, you're not taking it and going on vacation, personal trips with it, and you have a company policy that states that vehicle is not to be used for personal use, okay, then in that case there, it can be fully written off. Okay. Otherwise, you're going to have to keep track of miles, and then at that point, you're going to look at the mileage rate versus the actual cost rate. If you're in a corporation environment, you can't do miles. Okay, that you have to keep the actual cost, but you still have to keep miles per percentage of business use. Okay, so it is complicated. Bottom line, with the technology now that we have, Mile IQ, whatever the case may be, use it. Okay, and generate the reports, and your accountant should be asking for that. And if you go through and you tell your accountant, oh, I drove 10,000 miles, and you're stupid enough to put a 10,000 miles number on your tax return, I would never do that. Okay, and it gets audited, and believe me, it does get audited. Okay, then you're bottom line, just keep track of it.
Round numbers on your taxes are bad.
And it's kind of crazy. There's been times where I've gone through and I've gone through and actually did a detailed mileage log for a client, and they provided it for me, and sure enough, it added up. I've done so many returns, it added up to a round number. This has happened a few times. And I'm kind of like, we're gonna just kind of manipulate this thing down a few bucks. It's just like I just don't want to do that.
Hi. First of all, thank you for all your insights.
Oh, sure.
Helpful. I've read a couple of investment blogs, like kind of talking about the tax deduction changes and just the restructuring. And it seems like each different point of view is so different. And then especially now with the shutdown happening during tax season, do you think for most of the investors that are working with our CPAs that we should also kind of track the changes personally and then try and amend anything in the future? Because I know you can do it up to like 3 years, whatever. Because I feel like right now a lot of things are still in limbo, and I feel like that there's probably some deductions that are still sitting on the table based on how language is analyzed. Do you like recommend that for us to kind of track it? Because we all only have so much time with our CPA each session, and I'm just wondering how you can kind of make sure it all gets tracked.
Well, I'll give you my point of view. My favorite types of clients are educated clients. And I have some of them in the room. I'll mention Adrian, who's in the room. I love it because he called and he asked me pressing questions. And sometimes the answer is, I don't know. Okay? And I love the fact that if they read something and they call me, and I love telling them if I happen to have a disagreement viewpoint that I'm always right. Okay. But no, there's been times that I've gotten phone calls, boy, that's just not right. And then sure enough, I went and read on myself and go, no, my position was wrong on this. My perspective was wrong on it. So yes, I mean, I think you should, just as in any aspect of your business, I think you need to have a good handle on what's out there. Okay, number one. Number two, you're right as far as it can get expensive or just time. And even with myself, it's just kind of like trying to get to every single one of my clients and trying to do this, it can be very, very difficult. So it is helpful when a client does it, when a client is staying on top of things and they're asking good, healthy questions. As far as amending and going through, there may be a lot of that. And there have been situations that we'll go back and amend returns in prior years because of some changes. So yes, definitely.
What is your opinion on using self-directed IRA for the purchases of real estate investment?
Well, I have the opportunity to be actually in a mastermind and be in rooms with one of the larger custodians of self-directed, and they definitely have their place. And it's kind of one of those things. It really kind of depends on the individual. And I'm not sure from what end you mean as far as his opinion, because it kind of really depends on what you're doing. Bottom line, if you don't know what you're doing outside of a self-directed, don't try to do it in a self-directed. Okay, and make sure you know what you're doing. Some people get themselves into trouble with these, LLC, checkbook writing, LLCs, within self-directed, these types of things. They're there, just you need to know the rules, you need to understand the rules. That's a whole education process within itself, but they do have their place as far as if you're wanting to do lending, some passive activities, rentals, things of that nature. Self-directed can be a good place to do that and then blow up your wealth in there.
Would you recommend any custodian?
I would, but I don't know if it's appropriate to mention that in this room. I can give that to you privately, sure. But I don't want to create any problems with anybody who might be a vendor or sponsor in this.
I sell a lot of properties to people who flip and have rentals, and I've noticed a handful of people are buying the properties in the same entity flips and rentals. Is that a good thing from a tax perspective or a bad thing, and why?
If you're doing it out of a partnership, it's not, I'm gonna mention purely, you mentioned tax. I can mention asset protection here in a second. From tax, if you're doing, providing you're not doing it in an S corp, okay? Now, if you have an S corp and you have 1 or 2 rentals in it, and primarily it's, it's active, I would say okay. I would not recommend it from an asset protection end. But, fine. But if you're doing this, a lot of rentals, you have 15, 20 plus rentals, and then you have an active portfolio, yeah, you want to stay away from that in a singular entity.
Is that going to affect your taxes? Like for, my entity for rentals, if I do 2 flips in there this year, is that going to change the tax structure or anything, or does it not matter?
No, I mean, it's kind of one of those things that just happen from time to time, especially when you get into a project, think it's going to go one way, but you end up changing your mind and doing something else with it. Okay, and that happens. We all understand that happens. And so in that case there, it becomes a little bit of an outlier. It's not the general purpose of that LLC or that particular entity that you're doing that. But generally, it's advisable. If you end up doing 1 or 2 flips in it, it's not a big deal. But because I'm assuming it's not an S corp. So if you're doing it in a partnership environment, perfectly fine. If you're doing an S corp, I would say that try to get that rental out of that thing as quickly as possible and get it into a separate entity. And you don't want to wait too long because trying to do the revaluation on the depreciation basis can become a little bit of a headache. Go ahead, yes sir, that's my dad.
He must be a good guy.
Yeah, he was. That's him greatly.
I have an LLC question as well. So if I bought a property in my personal name, from a tax perspective, does the timing of moving it out of my name into the LLC make any difference? The LLC is a single member LLC.
Single member LLC, there is no tax consequences to that. So when you have a single member disregarded MD LLC, you have rentals in it. Okay. So you have your 1040, you have your Schedule E and your 1040 where your rentals are recognized, right? And so you go through and you say, okay, for asset protection purposes, I'm going to just quit claim deed this property. My property is 1313 Mockingbird Lane. I'm going to quit claim this thing deed, this into my LLC name. Okay, Mockingbird LLC. That's not a taxable event. So things just continue on as they always have been. Now, however, if you end up taking that and you end up moving it into a partnership, okay, into another taxable type of an entity, that becomes a taxable amount. So at that point, there could be tax consequences for moving it from your single member LLC into a different type of a taxable entity.
Do I need to keep records before and after the LLC switch, and account for that, or recap it separately on my tax return?
Not if it's a single member LLC situation, no. Of course, you're always keeping track of all those records, but as far as there being a kind of a change date or things being different on one side versus the other, no. Yes, sir.
Does that answer stay the same if it's a 2-member LLC?
Yes, it does, because at that point, if you're moving it from your own individual name into a full-time member LLC, which by default is taxed as a partnership, okay, in the state of Indiana, okay, when you can have a husband-wife, some states you can't, but you can have a husband-wife LLC taxed as a partnership, then in here, yes, that becomes a taxable event. So you essentially have to move it as a sale, basically from you personally. Even if you just go through a quick claim deed, it's still considered a sale from your personal name to the partnership. Yeah, that's of course, almost all loans have due on sale clauses. Okay, so a bank, if you go through and you change the ownership, banks can call those notes. You have to realize that is a risk that's there, that due on sale clause. Sometimes it's kind of a situation to where how risk averse are you? And most of the time, banks, as long as they're getting their money every month, they don't care. They don't question it, but they always have the right to. So it just becomes a risk situation.
So if the bank calls the note, can you just quick claim to yourself again?
I suppose. I mean, I don't know if that's a game you want to play, but I suppose you could. Ultimately, at that point, the bank's going to make the rules. They'll tell you whether or not you can or can't. I've seen it happen where when they go through and they question it, they force it the other way, and so you end up with this big huge headache. But a lot of times, it may just be as common sense as calling the bank up and saying, "Hey, for asset protection purposes, I'm moving this into an LLC. You're still a personal guarantee on it. They just want disclosure." Yes, sir.
Sorry, so going back to that previous question. So if I move the property purchasing my name into a two-member LLC with my husband and wife. So is there an election status I can choose tax purposes wise for that LLC and not have that event? Like you said, if we choose to claim taxes as a partnership, then it becomes a taxable event. Is there a status that I can choose at the end of the year that I won't have that problem?
Well, you can still just, well, you can basically unwind it and just still have it treated as a single member LLC. I'm not going to get into, managed member LLC, member, I guess get in the weeds. You can still have your wife on the LLC, but it's still considered a single member LLC for tax purposes. So basically, your spouse would not have an ownership interest in the LLC, but they would have essentially rights within the LLC. On that point, generally you want to make sure that you have these things listed in your will and these types of things to make sure that if anything were to happen. But also your organization documents that she's listed for the LLC purposes, but not for tax purposes. So she would not be an owner for tax purposes. You'd still be 100% owner, her 100% owner. So it's still a single member LLC for tax purposes, but they would still have certain rights within the LLC.
Any other questions?
Jeremy got one up here.
Can you change that designation after the formation of the LLC going from like a created LLC as an S corp to a partnership, or
The shorter answer is yes. So once you establish it, you have a certain timeline where you can change the initial election, and then from that point on, once you make the election, and there is some late filing procedures and elections that are out there that can be just a lengthy talk within itself. But yes, you can change it at any given point in time. But it could result, like from a partnership to an S corp or an S corp to a partnership, it could result in some tax consequences. But most of the time, your LLCs are just going from a disregarded entity to either a partnership or an S corp. And in those situations, it really does not generate a taxable event.
Do you know what a cost segregation costs on like a does it make any sense?
Yeah, you have to call a firm that specializes in that, and we've done that from time to time. We delegate that out, but depending on whether or not you have plants, whether or not how much paperwork you have, and how much work they have to do. If you're going to do a cost segregation study, you want to do it early on in the process, like pretty soon after you purchase the property, because once you get down the road, it can be a little bit difficult to try to recreate what was there initially. Okay. But it can be a little pricey. When you talk about an A flat, I'm going to guess it's probably going to cost you somewhere depending on where the paperwork is at the low end, $3 to $5 grand.
Any other questions? Once, twice. Awesome. Well, thank you for sharing. We're going to do deals. Look at those skills. So you probably learned a lot. You probably, whenever I hear Josh speak, I learn a lot, but always generates additional questions. So I'll be expecting a follow-up email from me. But he'll give you his contact information is up there. He's just down the road in St. John. So feel free to reach out to him with any questions that you have. And before we end, I don't have a slide for it, but we're going to open up for deals. If you have a deal that you want to talk about, this could be something you're selling. This could be you're looking for money, you have money. Raise your hand, we'll give you the mic. You have 30 seconds to talk about a deal.
Hello? Hey, I'm Dan with World Class Home Buyers. I'm the owner. I have a deal here in Holman in Detroit, in Hammond, Indiana. See if you guys are interested. It's a 3-story, 4-bedroom, 1.5 bath. I'm asking for $69,900. After repair, $133,000. Add packets if anybody needs it. So go ahead and raise your hands.
Everybody?
And half of that table is for our vendors, for them to leave information. The other half closest to us, if you have a deal, print out flyers, bring it there. That way people can grab that. All right, I saw a couple more hands. Wayne.
Hi, my name is Wayne Schaefer. I have 8 wholesale deals available right now. Crown Point, Hammond, Maryville, Griffith, and I have 4 more in Porter County and Portage, Hebron, and Valparaiso.
Are they all single-family residential?
Yes, they're all single-family residential.
Seaway. Anybody else?
Hi, I'm Deanna Pauly. I have a institutional portfolio that we're liquidating. It's a bunch of REO, all off market, lower level collateral in Indiana, Illinois, a couple other states. We're just looking to network and put them out. Some vacant land, sub $80,000 on most of the stuff. A lot of stuff in Chicago, some stuff down in India as well. We're happy to share the list. Let you guys go shop. You can see me or Ben the guy next to me.
Craig has a deal. Craig always has deals. It's the bald head.
Must be. I don't have any Indiana deals. I have 2 deals in Chicago. I have a 3-unit, 5240 South Honorary. Then I have one in Robbins, a 4-unit brick in Robbins, Illinois. Anybody wants some more info, they can contact me.
Anyone else? Awesome. I have some extra IRA money that I just got back, so if you're looking for a loan, I have about up to 50 I can do, so a small loan there. Also, my company that does a bunch of wholesaling and flipping, we are looking to fill a position, a lead assistant. This is a person that's going to take all our incoming calls, gauge your motivation, set appointments up. So if you know someone who likes real estate, maybe wants to get into the game, has a good personality, the drive to succeed, and some good personal communication skills, feel free to grab my card and connect them with me. So next month, we have 2 of our members are going to talk about the tax sale process. Coming up in March is the, is it the commissioner sale in March?
Yes.
Okay, it's what, yeah, the tax sale, where you can get some houses super cheap, but there's a lot that goes into that process and the due diligence. So Greg and Kim are going to share about that. They've bought over 200 tax liens here in the area. So if you're interested in that, you definitely want to be here. That's the 18th of February. In March, and this was a conversation that was on the Facebook page this month, someone asked about Section 8 housing, and it was all over the place, pros, cons. A lot of the negative people was just due to a lack of information. So I have Barb and David from the Hammond Housing Authority that does a lot of the Section 8 for many of the cities in the area. They're going to come in and talk about everything from how they qualify tenants, how they determine rent, the inspections, and everything that you need to know for that. So that's March. And then April, we're going to talk property insurance because there's a lot that goes on to that. And I know a lot of people just buy the cheapest policy out there. That's not always the best thing if something bad happens. So Ralph is going to talk about the ins and outs when it comes to property insurance. And then whatever month is after that, we're going to talk about how to find off-market deals so you don't have to fight over all of the MLS stuff. So the next 4 months, we have 4 great speakers, so definitely pop in. And if you want to talk to us about becoming a member so you have access to all the old videos and you get that cool bag, feel free to grab me, Justin, John, or Morgan out there. But thanks again for coming, and we'll see you next month.